Hello everyone. It's Cameron, and just want to take you through what will become the first of a series of real estate financial models in Excel. This one that we're going to be looking at today is a single-family residential house. Really pretty straightforward, although I am excited to show it to you. I think it's a pretty useful model for those looking to invest in a single property and want to do an appraisal of it. And just going to walk you through the main features of the model, and hopefully give you a better understanding of it. So today is the very first model, and again, I'm pretty excited to show it. Please feel free to share it around. It's going to be free for downloading. And what I'll do, I think, is I'll create a more lengthy video where I'll go into depth as to some of the formula in the model. I might even do one where I build it from scratch, just to help people who want to build it themselves. So, a little bit of a quick preamble. So in these real estate financial models, one thing you're going to notice is that there are no currencies. So I try and keep it as geographically agnostic as possible, meaning that I'm not going to have it all dollar signs if you're based in the UK, and vice versa if you're based in the US, using the pound sterling symbol. So you're going to have to deal with just the units. Something else you're going to notice in terms of the sort of overall format of the cells, anything blue text means that that's an input cell. So that's for you as the user who's going to go in and make changes based on the situation that you're in. So anything blue text is a user input cell. Anything black text is going to be derived from a formula within the model itself. And I think that's basically it in terms of sort of the usability of the model. A couple other points to note. So what this model assumes is the purchase, the renovation, and the optional renting, as well as the eventual sale of a single family house. If you're in the UK, you might consider this a buy-to-let strategy if you plan to hold on to it. In the US, SFR, single family residential home, or single family rental. Again, I try and keep it as geographically agnostic as possible. So let's quit with the chat, jump right into this model. So again, it allows you for the purchase, the renovation, the operation if you choose to hold on to the property, or if you plan on holding on to the property. It's going to allow for the rental operations to be factored in, and then of course, the eventual sale up to a hold period of 5 years. So anything beyond 5 years, you're going to have to extend the cash flows and do some adjustments to the model. But let's take you through some of the features of this single family model. So here we've got at the top, we've got main details. Property. Now it's these, so name of the property, property address, and the property city. I'm not going to have any bearing on the actual model, of course, apart from you'll see it pop up in a couple different cases. So we've got some kind of a summary snapshot of the model outputs that allows you to, if you as an investor are looking to raise money, it's going to just have these details shown in some helpful places for you. But the strategy. So you've got two different strategies here that you can really model. One being a hold strategy, you're just going to buy the property, hold on to it, for up to 5 years in this model, and then you're going to sell it back off. And the hope or the plan is that over the course of those 5 years, the property is appreciated in value, and you're going to have earned positive rental income. And that would be your investment strategy for the hold. For the flip strategy, the plan would be that you buy the property and perhaps rent it out for a shorter period of time, but really the aim is to put some money into it by renovating it. Oftentimes these are more dilapidated properties. You're going to fix it up quickly and sell it off to somebody, either another investor who wants to hold on to it, or potentially just a single, family house, somebody who wants to buy their family home. That's that part. We've got some of the purchase details. So obviously you want to have the purchase price. It's going to allow you to put in the months that you foresee needing to renovate the property. So we've got 2 in here. We've got a hold period of 30 months, and then factored in 4 months for the time that it's going to take to actually market the property and sell it. So for a total of 36 months. And then you've got the sale date based on the 36 months from the date of purchase. Now, one thing to note is that the date of purchase is the actual date that you're taking possession of the property. So don't put in the date that you in principle agree with the seller to purchase the property. This is going to be the day that you actually take possession of the property. And that's when the cash flows are going to be starting from. Got a construction budget. I'll show you the budget little template, which is right next to this shortly. And you've got a couple of your monthly property tax and your monthly insurance. Obviously change that to your situation in your marketplace. One thing too that I should have mentioned at the beginning, so we've got this model broken down into an inputs and summary tab. You're always going to start off with an inputs tab. I like to put summary stats, which I'll go through at the end there, on the same tab. Just keeps it more simple and quickly allows you to see the outputs once you change the inputs if you want to be, tweaking some of the variables. Next, I'll show you some of the cash flows over the course of the investment period. And finally, just wrap up by showing you what the pro forma looks like as a kind of an easier to view snapshot. So after the construction bit, we've got the acquisition details of the property. So you've got your purchase price, you've got your closing costs, so things like agent fees. I think 1.5% is pretty generous. This could go up to 3% or more depending on where you're located. And this is a percentage of the actual purchase price. You've got your due diligence costs. Could involve things like traveling around to see the property, hotels if you're coming from out of city or out of the area. Then you've got your sale details. So we're going to say that we're purchasing this property for $100,000. We're going to sell it for $175,000, and that's going to be sold once again in 36 months. But to sell the property, you've got to pay a broker, assuming you don't find the buyer yourself. And you've got other sales costs that can be factored in. Got a nice little picture of the property here that you can replace with the one you're looking at. We've got some financing details, so crucially important here, obviously. You've got your loan to value, which we've assumed 80%. You choose based on what you're able to receive, or if you're purchasing the property with all cash, then change that to 0%. So the loan amount's going to be $80,000, which is 80% of the $100,000 purchase price. But mortgage interest rate, I'd say 3.5% is pretty generous, and in all likelihood, you're going to be a little bit more expensive than that. Mortgage term, 30 years, is the period over which the mortgage is amortized. Interest only. So this is going to be another drop-down selection for you to choose. Here we've got it selected to no, which means that the payments, the monthly payments, are going to be a combination of interest and principal. I'll do another segment specifically on loan amortization models, and it's going to be a little bit more advanced than this. So this doesn't allow you to factor in any sort of prepayment of the principal of the loan, and it's a fixed mortgage. So it's now typically when you get into larger scale purchases, it's going to be variable, and that's tied to typically some sort of an index like or reference rate rather, such as LIBOR or Euribor. And so if you were to change this toggle to yes, then you're only paying interest payments, hence the reason why your monthly payment is lower. I'm just going to flick it back to no there. And last but not least, we've got operations. So again, this is going to be applicable in the hold strategies or any time that you plan to bring in a tenant prior to sale. Rental income, small operating expenses, property management fee, I'd say 8% is pretty conservative as well. More often I see this closer to 9 or 10%. We've estimated the number of days that it's going to be held vacant on any given year, and I'll show you how that plays out, how it gets modeled in the actual cash flows. It's a bit of an accounting treatment. Vacancy is a percentage, so we're saying that roughly a month each year it's going to be vacant. These are stats that you can check pretty readily in your local marketplace. Find out how in demand properties are. We've got provisions, so this is just going to be setting aside money for inevitable capital expenditure items, so bigger tickets like could be HVAC, the eventual replacement of a roof, etc. Then we've got some details about how the market can perform. So we're saying that income is going to grow at 3% per year. Annual expense is going to grow. We'll say it's in line with inflation. We'll assume that inflation's at 2.5%. I mentioned a bit earlier that we've got a budget tab here. And this is one of the interesting features of this model that allows you a little bit more flexibility, or if you've only got a rough estimate, it allows you to punch a number in as well. So break down a number of the estimated costs, allows you to slot in the vendor for your own reference, and sums it all up at the end. Now, as I mentioned, if you don't have that much detail, you really just have kind of a rough estimate, what you're able to do is put in a preliminary budget. So you might say, don't know that it's going to be exactly $25,000 to renovate the property. We might just have an idea that it's, around 20 grand. If you do put in 20,000, you're going to notice back at the inputs tab that the model is designed to delete this first. The model is designed to override a feature fix. Click up here into the formula bar so we can see the formula. So if the detailed budget total is blank, then it's going to allow you, it's going to pull from the rough estimate budget. And if there is value that's not blank in the detailed budget, it's going to take that figure. All right. Budget. And what we'll do is I'll wrap up the session by showing you the summary section down at the bottom. Let's move on to the cash flows. Here we've got across the top, you'll see pretty standard is to create a timeline. Now I've included the month end apart from the purchase date, which is here. We've got the month number. So there's a 5-year horizon. There's your 60th month. And the year number. These are all handy to have going across the top anytime you're doing cash flow modeling, because you're going to be referencing them all the time. So time zero, month zero, we've got your purchase price, closing costs, and due diligence, all of which were discussed in the inputs tab. One of the things that is worth noting is that you'll see in the formula bar that this references purchase price. Now this is a named cell I've created, and it comes in really handy when you're doing cash flow modeling, and I'll explain quickly why. So if you look in the top left here, you can see that purchase price is what pops up when you hover over the purchase price cell. As opposed to here, it's going to give you the reference, the position of the cell, so G22. By naming this purchase price, or something of your choosing, you're then able to quickly reference it in subsequent formulas or later formulas more easily without having to use anchored cells. It just becomes a whole lot cleaner, and you can quickly see that it's referencing purchase date as opposed to a certain cell, which you may easily forget what that cell represents. Okay, so after the acquisition details, you've got your optional income. So remember that 2 months in is the renovation time period that we've accommodated for. This rental income, and that grows at an annual rate of 3%. What we've done here is with the vacancy credit loss is, do you remember I mentioned the 1 month that we've allocated the property to be vacant on any given year? Well, we don't know exactly what month that's going to be, so we straight line this cost. We add it in as a cost because we know from our comparables or our research that it's going to be likely vacant throughout 1 month. So we've used the vacancy percentage. You remember that was about 8% or 1 month in the year, multiplied it by the rental income, and that's what gives us our gross effective income. So at the end of the year, you still expect to have the same amount of income as if you were to exclude this line and have it vacant for 1 month where the cash flow actually hits. So the net result is the same. Your operations, some of the operational costs of property tax, insurance, general OPEX in property management, and our total operating expenses. Subtract the operating expenses from the gross, the effective revenue rather, gives us our net operating income. Some of your non-operating expenses, so your provision for CapEx, which I'd mentioned before, and your renovation budget. You can see that the renovation, you remember the budget was $25,000. there it is, straight lined over the course of 2 months, which we've allocated for the renovation period. This is our cash flow before debt. So this is otherwise known as our unlevered cash flows before any sort of debt servicing, as opposed to our levered cash flows, which factors in that payment that we've made. So here's some of the financing cash flows. We've got a loan drawdown, and we've got our outstanding loan balance, which is on a monthly basis. And debt servicing. Now this is either going to be interest only or interest in principal, depending on what you selected in the inputs toggle. And there's a cash flow. Sale cash flows, so sales price less your broker's commission and other closing costs, and then pay off the debt. So in the 60th month, in the 36th month, you see here, you've got the sales price less these costs, and you're paying off the remaining loan balance, which is the loan balance from the financing cash flows above. And there are your net proceeds from the sale. These are all expected cash flows because what this model is doing is appraising a potential investment opportunity. So taking a look at what most investors are going to be concerned with are the returns. So these are your unlevered returns. Again, these are your returns before paying for any sort of debt servicing. So one quick check that you can do to make sure that this model is working correctly is that if you look at the internal rate of return, the IRR, for example, this IRR is going to be the same as the levered IRR if we don't use any debt. So if we quickly just go back here, I'll show you for the sake of understanding. Change the loan to value to 0%. We aren't using any debt. And update this. And lo and behold, we've got 15.5% levered IRR, 15.5% unlevered IRR. Uses that this model is working as it should. Quick check that you can do. So here we've got our ROI, our monthly return on investment. Right. Sorry. Our unlevered cash flows at our unlevered equity multiple. So this is the equity that we are given back for the actual equity or our money that we put into the deal. So we've got the equity from the sale divided by the equity that we've put in over the course of the investment period. So this is going to include things like 25 grand used for the budget, as well as any sort of operational losses over the duration of the 36 months. And this is just the difference between the two. This is the actual equity increase from the project. We've got our levered returns now. Levered returns, clearly we're expecting a higher rate of return just because we've got the added risk of debt. And we do see here that the equity multiple is higher at 2.12. And we've got an internal rate of return, which is more than double what the unlevered return is. So these are pretty healthy returns. And once again, from sale, you're only required to put in 48 grand as opposed to 128 grand because you are using debt in this scenario. And I will show you in the summary tab at the end where that gets summarized again. So in the pro forma tab, really what we're doing is just doing simple SUMIF formulas to aggregate the cash flows into yearly cash flows rather than monthly ones. Investors aren't going to want to necessarily sift through a monthly cash flow. They can just look at it and get a quick snapshot of what's happening on an annual basis. So here we've got the year and the year ending, going across the 5-year investment timeline. This investment obviously is 3 years, so you can only see cash flows therefore until the end of the 3rd year. All these cash flows are pulled directly from the cash flow sheet before, so this is all going to be the exact same except summarized on an annual basis. And that's it really. So let's toggle back to the summary tab. And there it's really got this snapshot. This is what I said earlier, is if you want to just simply print this out, hopefully this your needs in terms of you need to present to a potential investor. So the name of the property, details of the property. Notice everything that in black, so it's all being pulled in automatically. Purchase date, the amount of time that you're going to need to renovate, and then eventually the estimated date of sale. Your total purchase cost, which includes your closing costs and due diligence. Loan amount is going to tell you how much you can require at closing of the purchase. Got your renovation budget, any sort of carrying costs that are incurred throughout the duration of the investment, and your total equity required. Now, the equity required, you'll recall, is the equity required under the levered scenario, because in this situation, we're assuming 80% debt. We've got the net equity gain from the investment. Just expand that a bit. And it's got summary details of the actual operations. And at the bottom, just doing a comparison really of the levered IRR versus the levered IRR, and the increase in investor equity debt versus the increase with debt. So guys, that's it. That's the single family residential model. I hope you found this useful. Please do share it around with anyone that you might think will use it. And I will speak to you again soon, hopefully with what I'll do in next videos are sequentially more difficult models, looking at more complex scenarios, and really just aim to build up a bit of a database of Excel models for people to use. So ciao for now. See you again soon.